So I understand that many of you had some difficulty with the last case, FI2B, where we're looking at arbitrage opportunities between 3 securities. And so I'm going to do this very quick video combined with slides, hoping to clarify some of the things that may or may not have been too clear there. Now I understand this is a much more difficult case than the others, and let me explain where this is all coming from. So first, let's have a very quick recap on arbitrage conditions. A number of people made some statements in there, such as zero finance, portfolios and the like. And so I just want to make very clear how this normally works. A no arbitrage condition, a very general one for portfolios, is basically you have a portfolio that you build that costs you nothing today. So it costs you have to pay no penny for it. It essentially is what's referred to as self-financing, but it gives you a guaranteed profit in the future. So no matter what happens, you end up with more money in your pocket. If that is possible, that would be an arbitrage portfolio. There's another formulation, which is one where you have a portfolio that guarantees you that you get 0 payoffs in the future, which means no matter what happens, you have no capital outflows or inflows net at any given point in time. But this portfolio costs you a negative amount today. So it means you have a cash flow that goes into your pocket. So if either of these conditions is satisfied, you have an arbitrage opportunity. Now, what we will use in this case is actually the second formulation. And there's some particular reasons for this. It's because creating a portfolio that pays you exactly 0 is quite straightforward in this case. So what is the idea of arbitrage, generally speaking? It means that, or the idea of no arbitrage means that what pays the same must cost the same. Now, it's very important that you understand that arbitrage does not mean that, for instance, one asset is undervalued relative to some form of fundamental value that you compute, right? Because that's usually an estimation. It's based on on expectations and so on. That's not what we're after here, right? So this arbitrage means literally a situation where you get a guaranteed payoff for nothing. All right. Now, this is not the first time we've looked at this. We've actually done this before, right? So we started with the case in algo trading where you had the same asset that traded on 2 markets. There, the law of no one price has to apply, which means that the same asset, you buy and sell the asset on different market, but it's the same asset. Therefore, it has to cost exactly the same, and we have exploited the differences there. The second no arbitrage condition that we looked at was one where you had a T-bill and you had a savings account. And each of these would give you, given the right investment amount, the same payoff in the future. So therefore you had to make sure that it costs you the same today. So what you do there is you try to, again, correctly price one asset against another. What we're doing now is a much more general form, which is we're looking at portfolios of assets. So the idea here is that you trade several securities against one another and you combine them in such a way, you have to combine them in such a way that they're priced correctly. And that's actually the core of what we do in finance. So let me just give you an idea and just to recap the payoffs. And it is very important here that for this case, you completely ignore this idea of that there is this savings account. It is completely irrelevant, okay? And it's really important that that's something which doesn't feature into your thought process because it's not helpful at all. So let's just revisit what you have. Now, if you take, for instance, the T-bill, that gives you a payment of $100 6 months from now if you buy it. If you take the 12 months T-bill, that gives you another payment of $100 just coming 12 months into the future. Now, if you buy the bond, then there's a coupon payment of $5, which happens 5 months from now, because that's when the first coupon payment comes due. There's another coupon payment that comes 12 months from now, and then there's also the face value repayment that happens 12 months from now. And so now you're asking, how can we combine all of these assets in such a way that we have an asset, as I said in my first slide, that gives me a 0 payoff? Now, that's not an easy task. So they have different payoff profiles, and we want to put them together, and we want to find a way how we can say this correctly. And again, I'm just going to repeat it. Forget about the savings account. It is not relevant here. In fact, it's not helpful to think about it. So the solution that we're looking for is we want to construct a portfolio that gives you the same payoffs as these assets all combined, or as combinations of assets. And so mathematically, what we're looking at, we're trying to solve systems of equations. Now, in some sense, this is actually what we do in finance, right? A lot of it is actually solving systems of equations. That may be something that you don't like, but oftentimes that's exactly what you do. And you have done this before in other classes. You have done this, for instance, in the context of zero coupon bonds versus normal bonds. And that's actually precisely what we're doing here, but we don't even use the terminology. You've also done this in arbitrage pricing theory. If you ever did arbitrage pricing theory correctly, that's actually also the pricing of assets relative to one another. Okay, so now let's do the math. And I apologize for this, but I'm going to go through this quickly, but you can look at the slides and actually work out the math yourself. And let's say we want to build a portfolio where we have an investment of X in the T-bill and the 6 months T-bill. Then we have Y in the investments in the T-bill, which is 12 months from now, and we have an investment Z in the 1-year coupon. And what we want to do is we want to have the investment of X and Y in the T-bill should give me the same payoff as the investment Z that I put into the 1-year coupon. Now, how is that going to work? What are the payoffs? If I put X in my T-bill, in my 6 months T-bill, then 6 months from now, I'm going to get X times the face value repayment. And we're agnostic to what the face value is because I'm doing it mathematically now, right? Now, if you put an investment of Z into the zero coupon bond, what do you get? Well, you get the fraction, the coupon rate, which is a C percentage. In the case, it's 5% times the face value. So that's $5 in case of the case. So, in other words, what has to happen is that the X investment that you have in the zero coupon bond in the T-bills have to be Z times the coupon rate in the bond. So that's your first constraint. Now what happens 12 months from now? You have invested Y in the 12 months T-bill and you have invested Z in the coupon bond. Now what are the payoff profiles? Well, the repayment for the T-bill is Y times the face value F, and the payment for the bond is Z, the number of bonds that you have, times the coupons that are going to be paid for, which is C times F. Plus there's also the face value repayment, so that is Z times F. So if you add those numbers up, you have a second constraint, which is that the investment Y in the T-bills has to be the same as Z times C plus 1. Okay. Now, conceptually, I want to point something out here. So conceptually, at this point, and we're going to come to a little bit more information later, but conceptually what we have here is really an indeterminacy, right? Because we have 3 variables, X, Y, and Z, and only 2 constraints, right? Which is the payment for the bond, so the payment in 6 months and the payment in 12 months. So in some sense, this system will not have a unique solution. So what we're going to do is we're going to start with a particular solution. Now, another thing that we have to be careful about when we do a real trading strategy is we actually have to have integer values, right? Because you can't trade half a share. So, this is a little bit of a complication, but it turns out that in this particular case actually works out quite well. So this isn't always the case, but it works out for this case. So let's say for the sake of the argument now we pick X equals 1, because we have, as I said, there's only 2 constraints and 3 variables, so we have a degree of freedom, so we can pick the X. So if we do that, then the first constraint said X equals Z times C, so now we have X equals 1, so we have 1 equals Z times C, so we know that Z is 1 over C. Now we can insert that into the second equation, and where we have our Y, right? Because our Y was Z times 1 plus C, and so that gives us a solution for our Y, which is 1 plus C over C. So if we know the coupon rate and we pick X equals 1, we have a firm investment that we have to put in Z, that's the coupon bond, and we have an investment that we have to put in the 12 months T-bill. In the example of the case, we had the coupon rate was 5%. If we buy 1 T-bill, TB6M, so it's a 6 months T-bill, then it tells us that we have to buy 20 of the coupon bonds and we have to buy Y equals 21 of the TB12Ms. So in this case, actually works out with integers and so on and so forth. Now you can obviously scale this up. You can say X could be 2 or 3 and so on and so forth. And if you want to do this for any X, we call it now I, you will have that the investment Z that you have to make in a coupon bond will be 20 times I, and any that you want to invest in the TB12M, so in the T-bill, which is expires 12 months from now, is 20 times I plus 1. Okay, so that's basically any of these fractions would create a situation where the payoff profile is such that what you get if you put X or I into the TB6M and Y, which is 20 times I plus 1 into the zero coupon, into the into the TB12M, that gives you the same payoff profile in 6 months and in 12 months as investing 20 units of the bond, 20 times I units in the bond. Okay. All right, now what we've done here is I'm giving you a way how you can match the payoffs in the bond. Now, the next thing is that this tells me nothing, however, about the existence of an arbitrage portfolio. So all that I've done, if you go back like 5 slides where I said we want to have a situation where I built a portfolio that pays 0 in the future. What I have not done, I've not said anything about the price that you have to pay. So let's do a quick recap. What does payoff matching actually does? We have one portfolio where you put an amount Z into the coupon bonds, and we have another portfolio where we put money into the T-bills, so X in T-bill 6M and Y into the T-bill 12M. Now what happens is that both of these portfolios create exactly the same payoff one period from now, they create exactly the same payoff over its lifetime. So no matter what happens, each of these portfolios gives you the same payoff. So that means economically they are the same asset. And that means for no arbitrage condition, it must be the case that these portfolios cost the same. So that mathematically, that means that if I have the prices P of TB6M, I have the price P of TB12M, and I have a price P of with a 1-year coupon bond, then if I have X times the price of the 6 months plus Y times the price of the 12 months T-bill must be the same as Z times the price of the 1-year coupon bond. Right, so it's a very, very simple condition, and that means that we now have 3 constraints, and we just have, now in this case, by the way, we have now 3 constraints, where we have the payoff matching and we have the price condition, and these then together will ensure, when all of these hold together, that basically gives us a no arbitrage condition, generally speaking. However, for trading, this is not really what we're after, right? We're trying to solve a trading problem here. And that starts with the fact that, in trading, we don't have a price, right? We have bid and ask prices. But I want to go just briefly back to the case. So again, for any integer value X that I pick, so that's the amount that I put into my T-bill, I know how much I have to put into the bond, which is 20 times that number, and I have to put into my TB12M, which is the T-bill 12 months from now. That's 20 times that number plus 1. So in this case, it must hold that I, the amount that I put into my 12M, plus 20 times I plus 1 into my 6M has to be the same as 20 times the amount that I put into my coupon bond. And now maybe you see why in the class description I had this particular formulation. Now, as I said before, in trading there is no such thing as one price, right? We buy at the ask and we sell at the bid. So, and we're only looking at market orders here, right? So what we need to do if we want to translate this into an arbitrage trading strategy or a condition which takes the market conditions into account, we have to account for the bid and ask prices. So in other words, what you have to have is, if you build this portfolio, there has to be something that has to be true for the prices. So there are 2 conditions that we have for no arbitrage. It starts with the first, which is that the portfolio that if I sell the bonds, right? If I sell 20 times my bonds at the bid price of the bond, then that has to be, the money that I get from that amount has to be less than what I have to spend if I want to buy the portfolio of I times the 6M and 20I plus 1 times the 12 months T-bill, right? The second condition has to be true is that if I do it the other way around, if I sell the T-bills, so I sell I T-bills of the 6 months T-bill at the bid price plus 20 times I plus 1 of the T-bills at the 12 months T-bill, that has to give me an income, because that's the money that you receive from this, which is less than what I have to spend for the offsetting position in the coupon bond. Okay, now let me explain these equations in a little more detail, right? So the portfolio that we have these 2 portfolios, right, where we buy. So one portfolio was where we have I in the T-bill in the 6M and 20 plus I in the 12 months T-bill. The other portfolio was one where we had 20 times the amount of the bond. Now we know these 2 portfolios pay the same. So I would be, in order to extract an arbitrage profit, I would need to sell one and buy the other, right? Because so again, these payoffs, these profiles, both of these portfolios give me the same payoff at 6 months and at 12 months. But if I be able to trade them at a different price, then there is possibly an arbitrage opportunity. And the same, so this portfolio, what it does, it costs me, because I want to buy the 6Ms, I have to pay I times the 6M, the 6 month T-bill, plus 20 times I plus 1 times the 12 months T-bill, and I receive a cash flow of this portfolio of 20 times I times the bid price of the bond. And now if there is a profit to be made, then, so if there is a situation where what I receive from selling the bond minus what I have to pay for the T-bill, if that is a positive amount, then what you have is you have money in your pocket now, and at any point in the future, the payoffs are always net out to zero. So keep in mind that you sell at the bid and you buy at the ask. So selling at bids give you an immediate cash flow in your pocket, and buying at the ask is a cash outflow. So let me now do an example here. Let's take the following prices. The bid price for the 1 year coupon bond is $103.85. The ask price for the 6 months T-bill is $98.60. And the ask price for the 12 months T-bill is $92.40. All of these prices make perfect sense. It makes sense that the 6 months T-bill trades at a higher price than the 12 months T-bill, and the bid price for the 1 year coupon bond is somewhere below the face value plus the coupon, so that makes sense. It's kind of technically a discount bond, so it all works out well. Okay. Now let's suppose you do the following trade. You buy one of the T-bill 6 months T-bills, you buy 21 of the 12 months T-bills, and you buy 20 and you sell 20 of the 1 year coupon bonds. Okay, this is precisely the arbitrage portfolio, or the payoff matching portfolio that we talked about before. Now let's look at the numbers. So the cash flows that you have today from the selling of the coupon bond is $2,077. The cash that you have to pay is $98.60 for the single 1 year for the single 6 months coupon bond, for the single 6 months T-bill, and you have to pay $1,940.40 for the 21 TB 12 months that you pay. Now, if you add this all up, you make an immediate cash flow or profit of $38. So that's money in your pocket. Now let's look at the cash outflows that you have. 6 months from now, the first you have to do is you have to pay the coupon for the bond because you're short the coupon. So this is a cash outflow for you. So that's 5 times the 20 times the $5 coupon. Then, however, you receive $100 from the T-bill, the 6 months T-bill that you own. If you add it up, that's a net cash flow of 0. Now let's look at the payoffs that you have in 12 months. Well, in 12 months, you have to pay again 20 times the coupon payment, which is a negative $100 total. You also have to pay the face value repayment, which is $100, and you have to pay that 20 times. But 21 times you receive $100 in return for your 12 months T-bill. So if you add these up, again, you have a 0 cash outflow. So in other words, in the future, no matter what happens, this portfolio of selling the coupon bond and buying the 2 T-bills in the right proportion costs you nothing, or gives you nothing and costs you nothing. So you have a 0 payoff. But when you do this, when you take this portfolio, today you have a positive cash flow in your portfolio. So you're making money off of it. And that is the definition of an arbitrage position. Let me also do a graphical illustration here. You have at the top, you have the inflows, and at the bottom, you have the outflows. So today you buy the coupon bond that costs you $2,000.77. You buy 1 T-bill for 6 months, and you buy 21 T-bills for 12 months. That gives you a total net gain of $38. Now in the future, after 6 months, what do you have? Well, first you have to pay the coupons. So that's an outflow of 20 times $5 of a total of $100. And you have an inflow coming from, the exchange of the T-bill for cash. Now, the net gain therefore is 0. Now, 12 months from now, what you have is you have again to pay for your coupons. That's 20 times the $5. Plus for the face value, you have to pay 20 times $100. But you receive 21 times the T-bill income. And again, that leads to a net gain, a loss of $0. So why is this arbitrage? Because you make an investment in these portfolios. You make an instantaneous profit for a portfolio that later down the road is entirely payoff neutral, so creates no gains or losses. Now there's one last snack I want to point out, which is that the strategies I presented so far were always for the right at the beginning of the case. And as we talked about extensively before, anywhere in the middle you actually have to pay for accrued interest. So therefore you have to adjust your conditions to account for the accrued interest. So for the portfolio where you would buy the T-bills and you sell the bond, you have to add to the bid price the accrued interest that you would receive, because it's a payment that you receive. So that makes your constraint a little harsher for the for the T-bills of what they have to satisfy. And the same thing holds for the accrued interest when you take the opposite position, where you sell the T-bills and you buy the bond. Now, these conditions that I have here are the no arbitrage conditions. If these conditions are violated, you have an arbitrage opportunity. Okay, and that's it.